Today, my guest is Lior Gantz. He is the founder and editor of the free #1 rated financial newsletter, Wealth Research Group. He's an investor, and we're going to talk to him in a little bit about the booming real estate markets with opportunity, his ideas on passive income, and also wealth management. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. We would love to hear from you. You can like, you can share, and you can subscribe. And like I said, as always, we love to hear from our listeners. Also, if you would like to see how handsome our guests are, be sure to check out our YouTube channel, and that's Commercial Real Estate Pro Network. With that, I want to welcome my guest. Lior, welcome to CREPN Radio.
Thank you for having me, and I hope I don't disappoint on the handsome front.
No, I'm quite confident you won't be on the low scale there.
Okay.
But Lior, I can't say thanks enough for taking the time to do this today. I'm
Sure.
looking forward to our talk. But before we get started, if you could just take a moment and share with the listeners a little about your background.
So I'm 35 today, and not today, but this year. And my financial background was birthed in trauma, basically. When I was 13, my father's business went under, and I kind of had to make some money on my own while that was happening. So I started babysitting and coaching basketball and driving some deliveries and painting decks, selling in a clothing store, all sorts of stuff. And I ended up saving, this was 1997, I ended up saving about 20 grand until 2000. So in like 3 years, 20 grand worth of today's money. And the banker, I was 16, the banker told me, look, you have about 20 grand here. Do you want to invest? And this was June of 2000, so right after the dot-com bubble burst. And so actually a good time and a great time in retrospect. Not that I knew anything of it, but he said, look, get your parents to sign a waiver so you can, as a minor, invest. And I did. And then my grandfather heard that I was going to invest that money, and he gave me 2 books to start in investments. And those 2 books really shaped the early parts of how I looked at investments, and they still impact me a lot because they're very timeless books. One was about Warren Buffett. The other was about Peter Lynch, who was the greatest asset manager of the 1980s. And I started investing at the age of 16. Then I took on a life of itself, and I became an entrepreneur after that. And in about 2015, after about 6 years of this economic recovery in the U.S. and globally, a lot of friends and people that I knew that were asking me a lot of investment information, all that, said, look, you should really publish more of your thoughts, ideas, research, etc. And that's how wealthresearchgroup.com was birthed, basically in early 2016, more as a labor of love. It's a free financial newsletter because I think in our society, not just in North America and Europe, globally, I've been to many countries. And I can tell you, look, people just do not know enough about how to run their finances, how to build careers properly, etc., how to look at risk and many other things. So this is what we focus on in the newsletter, as well as focus on things that I invest in myself. So that's sort of my background with regards to investments and entrepreneurship. I'm a businessman, etc.
No, it sounds like baptism by fire kind of thing there, and certainly sounds like you had the will and the want for something better than just the circumstances that were dealt to you. So my hat's off to you. That's great.
Well, I'll tell you what, that was the first business failure. Then came the second one when I was about 18 or 19, and then a third one in 2007. So for my father, or the family business, whatever you want to call it, I was too young to be part of it, but it really made my life sort of without a safety net. And I don't know if that's good or bad, but at least it happened very early, so I can do something about it for my own father and mother. When that happened to them at their 40s and 50s, it's a different story. It is traumatic, but it also was sort of a blessing because it quickened me to research, and entrepreneurship, investments, etc.
Yeah. No, I was going to say what's that? Necessity is the mother of invention, kind of a thing. I mean, it sounds like
Yeah.
you were definitely in that soup there.
Yeah.
What line of work was your dad in?
Furniture.
Furniture. Okay, so basically the economic boom bust cycle
Furniture,
of
upholstery.
yeah.
Well, a lot of things contributed. A lot of current thing also, stuff that has to do with imports from China that took out of business local manufacturers and all that kind of stuff that happened in the 90s with globalism. So yeah, a whole range of stuff. Actually, a lot of stuff that has to do with leverage, proper leverage, debt accumulation. So not partnering up, not outsourcing and delegating out. Many times that I've thought about this, just in my own mind, and kind of assessing it. That's sort of the things that I've discovered that I think are the main things.
Got it. You mentioned the other instances. Can you point to common characteristics in those instances that I mean, you mentioned a couple like the global economy, definitely the imports and stuff, and I think clearly now just with the talk of tariffs and just the global whether it be Brexit or China or whatever, I think there's somewhat, well, I don't say somewhat, I would say that it's hard not to be more aware of how we're all connected, even though we work within our own little, whether it be your neighborhood, your state, your country, but the global connection is kind of something we don't always pick up on.
Sure. I think what's happening today is something I call peak open borders. And in the past 30 years, you've seen how Western countries have, or I shouldn't say the countries, Western based corporations, US-based corporations, European-based corporations, they took advantage of countries that have very cheap pools of labor. They trained them, they made them skillful, and that helped margins for companies advance and widen. And it also caused, as a side effect, it caused a lot of loss in middle income jobs for the United States, for North America, for Europeans, and it also caused a situation where there's trade imbalances. And so at some point, some president would have had enough of political capital and enough of his country's people's backs, right, to be frustrated enough to tackle this situation. It has its upside and its downside, right? The upside of corporations taking manufacturing to cheap labor countries is that the end product is usually cheaper. So it's positive deflation overall because you get more efficiency, more distribution, more variety, more competition, and for a better price. There's a lot of productivity in it, but we do not live in a global economy. It's not like we are all under one government and that government needs to take care of everyone at the same level. If that was so, it would have been, not that I'm saying it's a positive thing to have one government, but what I'm saying is that if you take one government that looks after a faction, a certain faction of people, then there's accountability to all these people. When the Chinese government or another Asian government has their own laws, the United States and Europe have other laws, and you want to create a global economy, there are going to be problems because the cultures are not the same, and if that is not addressed, it can lead to some sort of a peak of a frustration, of an imbalance, and that's what has happened. It's not like we are in a bad spot. We are just in a spot that is unsustainable as it is. We need to solve what's happening from here and going forward. We all appreciate the fact that the global economy has birthed many products, many services, a lot of productivity, but it can't be at the expense of so many people without those people getting some attention from any government. So look, if you outsource manufacturing to China, for example, and there's a loss of 4.5 million jobs in the States, and there's a loss of middle class lifestyle for many people in their 40s and 50s, the government should compensate for that by, for example, raising tariffs, or by mandating that companies that lay off people do retraining for these employees, so they can go back to society and become contribute again to society in new capacities. There's all kinds of stuff that we can do, but those people have been neglected. That was the main issue, and I think that is being addressed right now, and we're seeing big changes. I don't know if you caught the UN General Assembly address yesterday by Donald Trump, but it was all about what is America's vision with regards to how to make this a more level playing field. It's not. It's very easy to understand that the U.S. will never be able to lower the wages of its employees to meet these 48 countries that manufacture cheaper than China today, and that's not what they're fighting. What they're fighting is how to live in this new world that has so many pools of endless cheap labor, but redefining China's role in that world. It's not a small country. It's the second largest country in terms of GDP, with 15% of global GDP. And it's going to rise and match the U.S.'s probably by about 2030 to 2035. They're going to be as big as the U.S. in terms of military and GDP. And so when they classify themselves as a developed nation, and they get all sorts of breaks for doing that, with regards to how they treat their employees, their citizens, etc., that's what's being addressed. That's what's on the table right now. How can we basically modernize our conception of China, our conception of the U.S. and of the global economy to meet realities? Because a lot of us have been living inside of these mantras that we've been told for 20 years about the global economy that are not true anymore. So many Americans still believe that their middle-class lifestyle is not going to go away forever, that it's transitionary. This is a cycle, and it's coming back. Families that used to live on one income source, the wife would have stayed home. They believe it's coming back. They haven't come to grips with it. On the flip side, when you say made in China, people still think about cheap toys and stuff, and it's so untrue. In China, you have manufacturers of the biggest tech companies, American tech companies in the world, and very trained labor force. So I think that's the big thing that's on the table, and because it's such a big disruption, it's such a big change, it's impacting stock markets and bond markets and obviously politics worldwide.
So, there's a lot that you kind of brought to the table here with the kind of the global economy, and I'm just based on kind of the majority of the listeners are kind of real estate focused.
Sure.
I'm trying to think, can you kind of paint a picture how you see this affecting people investing in real estate? Or
yeah, definitely.
Can you paint a picture for us?
Sure. First of all, it's already impacted how people think about investment. So if you go to the year 2000, what you saw is basically America trying to revive its economies, its domestic economy, by slashing interest rates. In 2000, when I started investing, they slashed interest rates really low, And when you do that, you do not know what the result would be. All you know is that you've lowered the cost of borrowing. You don't know where people that will borrow that money will take it. And what happened was they took it and put it into real estate. And then you got a situation where the wrong people took on bad debts, and the wrong people gave out bad loans. And it all came to a screeching halt in 2008. But the premise was, I will slash interest rates and stimulate the economy in general. Let's see what happens, because you never know who will come in and take that money, because 85% of debt, of credit, is by the consumer, you, me, and the rest of us. Only 15% at that point in the year 2000 was government. It's very much different now, but back then. And so real estate was impacted since 2001 with malinvestment, with very bad distortions because of interest rates policies. Since then, what you've seen, because of the wave of foreclosures, you've seen private equity and institutional money coming in and buying real estate, something that they've never done before. And so you've seen millions and millions of units, apartment buildings, retail, commercial, server farms. I can talk land, etc. It goes on to the entire scope of any real estate that you want to talk about, from warehousing to cold storage. It's endless. And then you also saw foreign investors come in, because the United States experienced such a massive drop in real estate prices, something that we do not see in major nations. If you have a correction of 3 to 4% in real estate prices in major economies in Europe or in Australia or in the Middle East, etc., that's considered big. The U.S. had a 50% drop in some cases. So you don't see that kind of stuff in developed countries, and certainly not in the most robust country in the world. And therefore, you saw foreign investors flooding the United States, and either individually buying or through their pension funds, etc. And now you see a situation where America is being bought by foreign investors and by private money, by private equity money. But we are at the cusp of a whole generation of millennials starting to form families. So this is where the future of construction in the U.S. Is going to come from. You have about 75 million people that make up the millennial generation. Most of them have student debts, and once they start to trickle down that student debts, then the banking sector will open up and embrace them and start to lend them funds for construction and for mortgages, etc. And you will see U.S. real estate go from being more renter-oriented in the major metropolitans to people, millennials going a little bit outside of the major metropolitan areas to form their families, have children, etc. Different sort of housing that has to do with that. And this will be the biggest boost for the next decade, for the 2020 to 2029 decade. Remember, the millennials are now inheriting the jobs of retiring baby boomers. So they're going to inherit career path that have to do with higher wages, etc. If you look at their demographics, they are going to peak in earnings in about 2029. So throughout this decade, every year, millennials are going to experience better and better wages. And so there's a big debate whether or not millennials are a different sort of a generation than previous ones. Will they not form families at all, not get married, not have children? They are lagging, right? But that's just because of the debt that has to do with higher education in the U.S. right now. I think that will be addressed, and I don't think nothing's changed, in my opinion. I don't see any reason why somebody who was born in 1984 to whatever you want to define millennials at doesn't have the aptitude to get married and have children. It's absurd to think that this generation wants to live and be gone and not have family. I think they are thinking differently about family. They're thinking differently about many other things, but it doesn't matter. In the bigger picture, this is the biggest construction boom that's going to happen.
So let me ask you, because you bring up a couple of things. One is you bring up student debt. Two, you suggested a new wave of, you didn't say single family home buyer, but that would be what the traditional wave of, exodus from the city would be to the suburban, landscape where the
Sure.
families were raised and stuff. My question is, though, and there's lots of thought out there. I'm just kind of curious on your thought. The price of construction and homes, and I guess if we back up to the event that happened in '08, and we had this huge surplus of inventory that got gobbled up by all these institutional funds that you mentioned, right? Because of the bank, or not the bankruptcy, just the crash of the market. So they come in and they buy it up for cheap. Do you have a sense that they're going to sell that back out into the market, or are they forever now landlords and real estate investors? The funds.
You mean the funds?
Yeah.
Look, I think they will assess the situation as it progresses. They're not married to any asset class. And just it shows you that when they came in and changed their entire business model, starting to buy up real estate, it just shows you how flexible private equity is. They're not married to anything. If they see money making opportunities in carton boards, then they will go to carton boards. It really doesn't matter to them. They were very flexible and agile to be able to build the relationships and networks to get their hands on real estate. But I think in general, if you're not a real estate focused fund, if you're just private equity and you're very agile, I think they will start liquidating. But they don't liquidate like one at a time. They don't take a realtor and start selling. They're selling to other funds or to other big buyers. So they're selling 10,000 units at a time. It's not like they're gonna put for sale signs on homes and start selling. So I think that is one thing. In general, yes, I do think that once retail demand comes back, they'll start to liquidate because some of them have made a huge amount of money, and they can. So if you want to leverage this, right, what would you do? You can either refinance your entire real estate portfolio and then you stay with your real estate portfolio for many more years, or you liquidate and reinvest. So if those two things come along, I think they will rather liquidate than refinance.
Got it.
And take the equity out.
Because I think the whole question of more buyers in the market, and I'm talking about the consumer as the buyer as opposed to the institutional as a buyer. What I like what you said about how the millennials are now inheriting the jobs from the retiring boomers, which, okay, that supports higher wages and kind of more of a continuation of the model we know. But I guess my question to you is more about just the cost of buying versus renting, because I think that one of the things that, and I know it's all market specific. I live out here in Portland, Oregon, and I know that there are starter homes that are $400,000, and I'm like, that's a lot of money for compared to what you can rent for, kind of thing. But I mean, with interest rates being low, and interest rates kind of propel those prices, so it's all very related. But I guess what you're saying is that these people are going to become buyers. And my question is there not been a shift in that maybe that they continue to rent, just the properties that they are renting look different than what a traditional apartment might have been or something like that?
It's possible that the millennial generation is very traumatized by what happened to their parents in 2008, and they will remain renters for longer. But look, when you have a family and when you start having children, you look for a specific type of house. It might be not as the white picket fence of the 1950s and 60s. It might not be what your previous generations wanted, but they want their own space, their own house. It doesn't. It has more to do with what people want as parents in general. And renter neighborhoods are different than owner neighborhoods. It's different school districts. It's different lots of things. Access to the highway where you get to your job quicker, better restaurants, all the amenities. Look, in general, they are not a replica of their parents. And I'm not saying that America is going to move forward in the way that it did before. All I'm saying is this time isn't different when it comes to the aptitude of this generation to, tie the knot, have children, and do all that kind of stuff. They are not exactly the same as their parents, but it doesn't matter. In the end, I do think that America is moving into an environment where I don't think home ownership is sacred anymore. So if that's what you're asking, I think, yeah, you're right. I don't think it's sacred anymore. I think many people will continue to rent. The price of the cost of ownership versus the cost of rents, when you talk about that, there are cities which it's much cheaper to rent than to own. And the flip side, interest rates are generationally low, and they're probably going to stay low for a very long time. So the incentive in getting into real estate, whether it be even to own an investment home and rent it to somebody else, is also there for them. So they also understand that I can buy a home and just rent it out. I don't need to actually buy a home just for my own purposes. I can rent my own home and buy another one and rent it out. The fact of the matter is, real estate traditionally and through the years has been very stable. It's outside of the stock market, and no matter what's happening with the S&P 500, you get your rent. There's a lot of ways of getting into REITs, real estate investment trust, that invest in stuff that you and I as individuals can never get into. You can in one buy order, you can invest in a company that rents their offices to the United States government. Talk about a good renter, right? You can invest in companies that own hospitals and healthcare centers for the baby boomers. You can invest in REITs that own outlet malls or premium malls or server farms, cold storage like for Amazon to ship their food, and Whole Foods to ship their foods. They have to have logistics centers, warehouses for the legal cannabis industry. You can get into so many things as an investor through REITs, both private and public. You can get into land, agriculture land, timberland, etc. So I think once they start having more discretionary income, lowering their debt levels that they're exposed to from their student loans, and start to think about the future, they will start to invest that money. The cash is so bad right now, treats people so badly with the way that banks honor interest rates right now, that you're almost compelled to invest. And so I think what millennials are trying to do, as well as every generation, they're trying to understand what is the best solution for me, because cash is doing nothing. So for baby boomers, what they don't want to get exposed to is any meltdown. So they're looking for anything that's more short-term or not market related. So a lot of people have moved into private lending. You can lend money for 3 to 6 months. You get about 6 to 8% annualized. So that's one thing. Or you can go into REITs or MLPs, which are master limited partnerships, and you can make money by basically because the government forces these entities to distribute 90% to 100% of their profits, and these are companies that have thousands and thousands of pipelines for natural gas and oils, etc., and they share in the in yields of 10%, 14% at some time at some point, etc. Or you look for high yield bonds, and people have been looking less and less. Those people have been looking less and less to the stock market. If you're younger and you can wait it out. In other words, if you put your money in an asset class and you can wait for 20 years, then there's no reason for you not to go into the riskier stock market, because it is true that in the short term the stock market has more volatility than bonds or private lending or anything else. But if you look at the 20th century or the past 200 years, if you put $1 in the stock market, especially the U.S. stock market, $1 has now become more than $700,000 since 1812 in the past 200 years. So when you talk about returns, you cannot beat the American enterprise system. There's just nobody has found anything that remotely compares to what this country has between our ears when it's focused and when it's allowed to unleash the potential. Now, look, can it change? It can, but will it? Most likely won't, right? In 250 years, it's been through 2 world wars, flus, influenza, oil shocks, whatever was thrown at it, and still, if I look at the best American companies, they're growing at 5 to 7% a year, like a Swiss clock, and they're dishing out 2 to 3% dividends. So you're growing your wealth at 10% a year. And as long as you're not scared every time somebody says impeachment or Brexit or whatever else, you're compounding wealth over the years. And myself is a great example. I was 16 years old when I read these 2 books, right? One from Peter Lynch, one about Warren Buffett. Warren Buffett talked about brands. Peter Lynch talked about businesses you can understand in 30 seconds. And you don't have to get complicated. So I was working as a clothing salesman. I was 15. What did I know? Clothing brands. So I researched what clothing company owned all these brands: Timberland and John Sport, North Face, Lee, Wrangler, and it turned out to be one umbrella company called VF Corp. I put most of that 20 grand that I talked about in that company in 2000. That company went from $6 a share to $100 a share, making you 16 times your money. Its dividend went up 700%. So in real estate terms, because your audience is real estate, that's like putting 100 grand in 2000, and now it's worth 1.6 million. And the renter that was in there used to pay you $1,000 a month. Now he pays you $7,000 a month because his dividend, his yield, has compounded times 7. Now, real estate cannot do that for you. REITs can do that for you because REITs grow. REITs are companies. They use debt. They use brains, right? A house, unless you know how to extract value from a house, make additions to it, you know how to find neighborhoods that are up and coming, so the price of the valuation of the neighborhood itself goes higher. You will never be able to replicate that sort of a growth dynamic. Because a house is a house. It is a house. It just stays there, right? It moves up with inflation most of the time, as do the rents. But it cannot, it doesn't grow its own rooms. Whereas companies, they can become more profitable, leaner, open new markets, etc., and grow. That's the difference between something that can grow and something that is stationary and more of a protective asset. So, in general, if you actually look at all asset classes from the year 2000 to 2019, REITs have beat all other asset classes with 9.9% a year. If you just buy and hold, do nothing. The 1st of January 2000, buy REITs, do nothing until 2019. Make no commissions for Wall Street. Just hold on and do nothing. Every time that there's a news flow, do nothing. You could have compounded your wealth at 9.9%. Oil 7.7. I think gold was about 6.8. Stocks 6.2. The average investor, get this, all of this time, the average investor has made 2.2%. And why? Because he goes in and out at the worst possible times. He didn't even beat inflation. So, look, the bottom line of what I'm telling you is that if you ask me what risk is not knowing what you're doing. That is the biggest risk. The second biggest risk is not knowing the people you're investing in. The smaller the business, the more you need to know about the people running it. The bigger the business, the less you need to know about the people running it, because the culture is already set for growth. So when you invest in Google, you don't need to know the 40,000 employees and how their life are going, etc. You need to know that, hey, this is a culture of a company that is growing at such and such. This is the industry that it's in. These are their competitors. But you don't need to know like everything about the CEO. When you invest in a small cap company or in one particular house, you need to know all about it because the risk is huge. So when you ask me about risk, when the more you go towards I'd say safer investments, the less research you need to know about the actual people. The more you dive into speculative areas where you can make much more money. That is true. You need to know all about what you're doing. So it's a function of how much time you have and what is your capability to self-assess yourself. Can you even is your research worth something? In other words, do you know what to ask? Do you know what to look for? And if you don't, then look, there's a machine out there that makes you about 8 to 9% your money every year if you do nothing but invest in one thing and just stay the course. So 8 to 9% a year, you double your money in every 5 to 6 years. I think if you have a good career, which is always the number one thing to take care of, then investments could be very profitable for you.
Hey, Lior, you kind of beat me to the biggest risk question there, but I appreciate you kind of taking us through that. But I wanted to ask you a little bit more about REITs.
Okay.
You mentioned REITs, and can you explain? Is it basically a stock fund? I mean, are you buying in a fund, or do you participate in any kind of the depreciation, or are you basically just getting the return from the incomes less the expenses? They pay out the returns. I mean, so
imagine just a company
right.
that invests in real estate,
right?
Okay, and you own part of that company. So it is not any different than owning a piece of Microsoft, for example. Now, if Microsoft has debt, that's not your own personal debt, right?
Right.
So it's the same with REITs. You do not own the real estate. You own a part of the trust of the REIT, and so whatever they're doing, the management team, buying assets, etc. At the end of the day, there's a price that reflects the value of the REIT, and that price is not 100% correlated with the assets because it floats as any stock in the stock market does in a matter of milliseconds. So, for example, if the CEO is involved in a car accident, nothing to do with the assets, right? Themselves, the assets keep producing, etc. The CEO is got involved in a car accident, and now the company has said, look, our CEO is in the hospital, we may not recover. It could be that the REIT goes down in price by 10 to 15%. Nothing has happened to the real estate aspect of it, but the fear that maybe a new CEO would not be able to replicate the performance of the REIT, etc., creates a situation where there's price fluctuations. The biggest reason to own a REIT is not so much the growth, but the yield. So for most people that invest in REITs, they want to go there because REITs usually are paying the highest dividends in the markets, between 6 to 14% at times. We talk about some specific REITs that I invest in the Wealth Research Group newsletter, for subscribers. But there are growth REITs as well. So the growth REITs, what they would do is they would use most of the income coming in, and instead of distributing it out as dividends, they would reinvest them in buying more equity. That's more of your tradition. That's what companies do basically. They distribute less and they try to grow internally more. As a REIT owner, you distance yourself from the actual real estate, so you cannot do all the depreciation, all the tax benefits, etc. But on the flip side, they do it for you. So
got it. So you're basically getting the dividends, and then whatever the value of the stock is when you choose to sell. If there's appreciation, that's that. So that's I got you. I had we talk a lot with guests that are syndicators or they go out and raise money for a deal and basically run the deal, but it's specific to a particular property, and the investor then gets the K1 at the end of the year, and it shows income. But you also get
that's something different.
Yeah, you get the depreciation there, and I assumed that was not the case with the REIT, but I appreciate you taking us through that.
It isn't, but the management obviously depreciate everything, and
right.
So it's already reflected in the price if they do a good job of that.
Right. I mentioned you kind of beat me to the punch on the biggest risk there that you mentioned. You mentioned basically knowing the who and the what kind of is being the risk there.
Where you stand is where you sit.
Yeah, exactly. I guess my follow up to that would be: is there any way that you recommend people go about lowering that risk? Is there is it basically just dig deep and educate yourself on the who? That was kind of what I heard you say there.
So I think let's take risk as a philosophical and then risk as a practical. Risk as a philosophy, I think that's the most important aspect of investing. If you obsess about risk, then you will do much better than anybody else. Now, how can you lower your risk? The number one thing is knowledge, because if you have knowledge, then many of the things that people do wrong, you will not do. Do you agree with that? That if you know more, then there's a chance that you will do less mistakes. Now, investing is emotional, and so many people know more, but they don't act on the knowledge they know. In other words, you know that you shouldn't be mad at your children, but at some point something incites you and you are. So that's the difference between knowing something and actually being able to resist the emotions of acting in an irrational way. But if you have that combination of emotional capability and knowledge, you are on another level. Because if you have enough knowledge about the stock market in general, you'd know that the best thing you can do to lower your risk is to just own the market. And owning the market means just own the S&P 500, for example. Just own a basket of the 500 biggest companies. Why is that lowering the risk? Because you're not exposed to any one company, and so you don't have to do all of that research into one company, and any company can experience a problem. And on the flip side, you know a lot about the historical returns of the S&P 500 because it's been going on for over 60 years now, right? So that's one way to lower your risk, is to know what history tells you. That's one thing. Second way to lower your risk is to float your ideas, like we are doing in this interview, with other capable people. The world's biggest hedge fund manager, Ray Dalio, attributes his success to that idea. Going into a room with other capable people, telling them what he thinks his idea is, his best investment idea, and letting them attack him with questions about why that idea sucks. And then if it doesn't, it just passed through the minds of 30 people who cannot refute it. And if it did, well, now you know. Because if you're a good investor, you're not in love with your ideas. You're in love with the truth and with what works. So that's the second way to lower risk. Make sure that you have a group of people that can honestly talk to you about your investment ideas, and then be honest with yourself about this. So for an example would be, you're in love with something, you just read it, you think it's the best idea ever, you go to a friend of yours, he starts poking holes at it, and you say, you know what, you are right, or you know what, I should look at it again, etc. So that's being honest with yourself. That's another way to lower risk. That has to do with the personality that you have. And obviously, another way to lower risk is by diversifying. So you don't need to just be in the stock market. You can be in other asset classes as well. The more you have exposure to cash and to precious metals, for example, the less you take on market risk. So if you want to lower your market risk, then go outside of the market to other forms of assets. Now, cash historically has been the least volatile of them all, but you are guaranteed to lose money. In other words, if you just want to lose 2 to 3% every year, just be 100% in cash. Remember, 2-3% a year in one decade, you'll lose about 20% of your purchasing power. So that's why some people, instead of doing cash, they do precious metals, which actually rise according to the price of inflation. And then if preservation of capital is not your main focus, if growth is, then you should lean more towards stocks in general, or real estate, or REITs. So it's just a balance of these things, and understanding that diversification does lower risk, because when something goes up, there are asset classes that are inversely correlated, and another thing goes down, and you get a better hedge. So it has to do with that. And then obviously the biggest, by far, any I don't want to say idiot, but anyone can understand that the best way to lower risk is to buy as cheap as you can. So in anything, in any investments, if you can buy cheap, in other words, after a very large price discount compared to what it's usually selling for, then you're lowering your risk. Now, I'm not saying that you need to wait for real estate to go down 50% again, because that may never happen. But if in the past 20 years, real estate has been yielding 6%, and now it's yielding 9%, which is 50% more, it means it's cheap compared to the rest of the 20 years. So you're in a good spot. In other words, you don't have to look for bankruptcy type pricing, because that may never happen. In some cases, some companies, some assets are so good that even if you have a few percentage points of discount, that is considered cheap. So just remember that, because I see so many people say, I'll wait for the next crash, and it might be 2050 before the next crash arrives. So I mean in real estate, like something like a meltdown, like a 2008. So just remember, it's all relative, right? If you can find discounts that are relatively big, but it doesn't have to be 30 or 40 or 50% off. That rarely happens in today's world, because unlike 30 or 40 or 50 or 60 years ago, information flows so fast that usually if something is very attractive in price, it doesn't stay that way for a very long time. It is much more rare than before.
No, I appreciate you diving into that a little bit and sharing your perspective, especially on the fact that those that are waiting for the next big correction, that while the on a global or more of a 30,000 foot view, you can argue that there's a correction that's due. The assumption that it's going to be as big or as bad as the one we just came through is probably incorrect. And so anyway.
there is no major excesses or excess like EXCESS, right? There is no excess. There is no asset class that is just people are paying whatever in it, and everybody and their sister are talking about it. So we don't have huge bubbles in major asset classes. I could argue that government debt is in a weird situation where the governments are getting paid to borrow money. That is insane, in my opinion. But whether or not it's a bubble is debatable, because if you are lending money to a government and you lose a small percentage every year, and you are fine with that because you fear that other asset classes would lose you far more, then there is rationale in it. I personally, as an individual, I do not need to worry myself with this, but funds and sovereign wealth funds that manage billions and billions of dollars and they don't know what to do with them, then that is one asset class that they chase. So yeah, it is. I don't know if it's a bubble, but it certainly is an interesting part of our investment world. Negative interest rates, but if you look at the, like you said, a 30,000 feet view, what I see is that we have more scientists today around the world than at any time in history, more engineers, more technology, more everything. We have 3 billion people, Asia and China and India that know English, China that are working 7 days a week, and these people are unleashing wealth. They're moving into the middle class. They know more. They're entrepreneur in minds. They're moving forward. The world is moving forward as a whole, and we've seen these things before, where there is what we call a deflationary boom, where productivity is so good that prices come down and there's more profits. In other words, if you're a doctor and not even doctor, think about a vet that in today's world can take on 6 clients an hour and he can charge them $50 per client. Then a software company comes up with a way for him to see 9 clients an hour, and he drops his rate actually from 50 to 40. He still makes $360 an hour instead of 300. So he just made his profitability better by 20%, and the consumer is better off by 20%. So that is a deflationary boom. And that can really, you can really see, look, Skype, how much is this call costing you? Nothing.
Yeah, nothing. Not yet.
The quality would be would be amazing. It will go on YouTube. It will generate traffic for you, for myself, etc. This is productive behavior that we're doing. You are in Portland. I'm currently in Italy. This 20 years ago was impossible.
Right.
And my admin that set this up is in California. So this is incredible. This is not only that. When you want to know something, you go to Google. How much does Google charge you for all of these insane things that they give to you? All of these free services that they took all this time to do. I mean, the amount of innovation that we have in this world is incredible. The world is getting richer and wealthier, but it is getting also more specialized. And that means that all these repetitive jobs, mundane jobs are going away. And that is a problem. That is a huge problem because many people are dependent solely on that sort of a skill. And so I'm not saying that we are out of the woods. We're definitely not. Innovation and specialization cause major disruptions and leave millions of people without jobs and without a future. And that will be the free market's job with entrepreneurship, and government's job as the keeper of peace and order to decide what to do. But the bottom line is that we are in a wealth creation phase that is huge, and our problem is that we need as a society to find ways to make it so that everyone or more people are part of it. So we are increasing the pie. It's a matter of making sure that people don't go starve while this pie is getting larger.
I like it. Lior, I've enjoyed this. Before we wrap up here, where can the listeners go to learn more or connect with you?
So wealthresearchgroup.com is the actual website. If you go to the homepage, you can either just, if you want to subscribe to the newsletter, that's where we publish our highest priority top quality ideas, including stuff that I invest in myself. If you look at the top menu, you'll see a special reports button. That's where there's a wealth library of PDF files from over the years that I've made as standalone reports you can download. And no matter which you download, the automated email that gets sent to you, at the bottom of it, if you scroll, there's all the other ones. You don't have to keep going to the website and just filling in your email to everyone that you like. And basically that's it, I guess.
All right. Well, Lior, I can't say thanks enough. I've enjoyed talking with you, and hope we can do it again soon.
Definitely. Thank you, sir.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.